Today, Bitcoin soars back to the $94,000 level. The second largest teachers union writes a letter to senators opposing crypto market structure legislation. And Samir Kerbage of Hashdex breaks down his expectations for markets and the firm's crypto forecasts for 2026. Welcome to CNBC's Crypto World. I'm Talia Kaplan. Digital currencies are solidly in the green this morning as the Fed's December meeting kicks off. Markets are betting the central bank will lower its key overnight lending rate by another quarter percentage point. By noon Eastern, Bitcoin reclaimed the $94,000 mark for the first time since the middle of November. Meanwhile, Ether jumped to the $3,300 level and Solana climbed to just under $144. Now, the moves higher also come amid new insight into regulatory progress tied to crypto on Capitol Hill, and we'll have more on that in just a bit. But first, taking a quick look at shares of 21 Capital, the Bitcoin treasury firm run by Jack Mallers cratered more than 20% in its public debut amid broad volatility in the crypto market. When asked about the recent swings among digital assets, Jack Mallers said, "If you can't stand the heat, stay out of the kitchen." Okay, back to crypto regulation as we take a look at the top stories. The second largest teachers union is urging the Senate to oppose crypto market structure legislation. In a letter obtained exclusively by CNBC, the American Federation of Teachers said the Responsible Financial Innovation Act, a bill outlining market structure regulations for crypto, poses, quote, profound risks to the pensions of working families and the overall stability of the economy. AFT argues that the bill doesn't provide common sense guardrails, but instead exposes families with no connection to cryptocurrencies to economic risk and threatens the stability of their retirement savings. The union says it's especially alarmed that the bill would let non-crypto companies put their stock on the blockchain and evade securities regulations. This, AFT argues, would allow crypto to completely avoid investor protections. The battle over crypto market structure has been heating up as 2025 comes to a close. CNBC also confirmed that on Thursday, the CEOs of Bank of America, Citi, and Wells Fargo will meet with lawmakers to discuss crypto market structure proposals. And speaking of that crypto legislation, the Blockchain Association Policy Summit's second day took place today in D.C., with speakers including SEC Chair Paul Atkins and several lawmakers. Senators Gillibrand, a Democrat, and Cynthia Lummis, a Republican, are two crypto advocates who joined a chat to break down the status of crypto market structure legislation. Senator Gillibrand told the audience this morning that lawmakers are making progress. During the panel, Senator Lummis said her goal is to share a draft of the Senate's version of a market structure bill by the end of this week, then let the crypto industry as well as Republicans and Democrats vet it and proceed to markup next week. Finally, crypto wallet firm Exodus is launching a payments platform. The company announced today that Exodus Pay will allow users to manage all of their assets in one place, including dollars and crypto. They can make instant payments, spend with a card, earn rewards, and access everyday money tools. Customers can also send digital dollars and stablecoins to friends using phone numbers. The move is part of a larger push by the industry to go mainstream, as Wall Street also embraces the crypto industry. Exodus said the new product will begin rolling out early next year. All right, for our main story, Hashdex released its 2026 Crypto Outlook Report. In it, the crypto asset manager lays out its latest guidance along with some predictions for the year ahead. I spoke with Samir Kerbage, Chief Investment Officer at Hashdex, who was integral in writing the report about those forecasts and his crypto allocation recommendation for investors. Well, Hashdex released its Crypto Outlook Report last week, and we'll talk all about that in just a bit. But first, I want to focus on what's happening with crypto markets right now. Bitcoin is trading back above $90,000 today after trading below that level for several days, including just yesterday. And this is after Bitcoin hit new all-time highs several times this year, reaching its new record above $126,000 just 2 months ago. Obviously, Bitcoin is a volatile asset, but what do you think is contributing to the cryptocurrency's moves right now, and how much are macro factors weighing on price?
So it's been definitely a very active year in crypto overall, and we've seen two big forces moving crypto prices. The first one is long-term investors, long-term holders who've been holding crypto and Bitcoin for a lot of years. They are using this, all-time highs to sell the position and rebalance the position. So we've been seeing this throughout this year, and this movement was very strong, especially after the last all-time high. The other big strength that we see is institutional investors consistently buying, consistently making their allocation throughout the year, and they're especially active in this last quarter. So just those two factors combined are creating, at the same time, some realization in the short term, but we're seeing crypto changing hands from retail investors that have been here for a long time and now are taking profits to institutional investors. They're making long-term asset allocations. And of course, subject to all of this is the macro conditions, right? So we're seeing, tensions around, the trade wars and tariffs. We're seeing, the AI trade, how that's going, the overall macro conditions and the US economy. Everyone is looking at what the Fed is going to do with the interest rates and how that's going to look like in the future. So all those factors are combining to see a price stabilization, a price discovery. So we're in a moment in which prices are mostly trading sideways, and we expect that to continue for at least a few more days and weeks until we have more developments on the macro level or until we have more consistent demand on the buy side.
Turning to your new report, you had some interesting crypto market forecasts, including that stablecoin market cap is expected to double next year and that stablecoins could grow 13 times by the end of the decade. What were some of the factors that led to those bold predictions? I'm assuming the Genius Act stablecoin bill becoming law here in the US over the summer and increased institutional adoption of stablecoins contributed to that forecast.
Yeah, for sure. So stablecoin has been growing exponentially, mostly outside of the US. We've seen huge adoption in emerging markets, in countries like Venezuela, Argentina, Nigeria, China, Brazil. The numbers that we got last year, 30% of all the FX transactions, the dollar-denominated transactions in Brazil, went through stablecoins. So it's a huge adoption in emerging markets, but not much in the US and Europe. And the reason for that is lack of regulatory clarity. Now with the Genius Act, the US government is not just giving the regulatory clarity for stablecoin issuers to start offering those services in the US, but also they are pushing for stablecoin adoptions. And we talk about this in our crypto outlook. We believe this is possibly a new monetary standard that we're calling the crypto dollars. And this can come to replace the old standard, the petrodollars. That's why we're so bullish about stablecoin growth. We expect it to at least double next year, and we expect at least a 10x growth in the next 5 years. We're very optimistic about stablecoin growth because the US government is pushing for its adoption, and we're seeing all the big financial institutions and all the big tech companies starting to integrate stablecoins into their payment rails.
Now, your report also has a whole section devoted to tokenization, one of the themes that Hashdex believes will drive crypto in 2026. Your prediction for next year, tokenized real-world assets are poised to grow by a factor of 10. Some of the implications for investors noted in your report: enhanced liquidity, fractional ownership, and efficient settlement. Take us through what you think people can expect when it comes to tokenization in the new year.
So there's a lot of benefits to tokenization, but the big problem now, there are two problems actually, is dollars are not on chain. And the second problem is the lack of regulatory clarity. What are securities? Which of those assets are commodities? Which are securities? And if they are securities, how they can be offered under the US legal framework? All those things are being worked at, both from the SEC and also on the Congress with the Clarity Act. Once this Clarity Act is approved, and once there is a clear guidance from the SEC, we're going to see more financial institutions experimenting with tokenization. And this is going to be at the same time that the US consumers and corporations are starting to embrace the digital dollar with stablecoins. So once all those dollars are tokenized and our dollar balance is on-chain, it's going to be way easier to access tokenized money market funds, tokenized bonds and equities. It's just going to be easier than going through the traditional rails. That's why we expect that as stablecoins grows in the US and as regulatory clarity comes for tokenized assets, we expect this segment to grow even even faster than stablecoin adoption in the coming years. So we're expecting a 10x growth. Right now, the segment of tokenized assets is just around $30 to $40 billion in assets, and we have $300 billion of digital dollars. Once those digital dollars reach $600 billion or $1 trillion, the next natural demand is going to be to look for yield and income and investment alternatives on those assets. That's why we also very optimistic about tokenized assets growth.
Interesting. Now, there's also a whole section in your report focused on how AI is fueling a stronger investment case for crypto. Hashdex predicts the AI crypto category is set to reach $10 billion next year. What was the reasoning behind this prediction, and why should investors care about the intersection of AI and crypto? One point in your report, crypto allows for economic autonomy for AI agents, turning them from tools into actors capable of independent financial decision-making. So can you elaborate on that point and others tied to the convergence of AI and crypto?
Sure. So Tyler, think with me. AI agents don't have social security numbers, don't have bank accounts, they won't have credit cards. How they're going to transact, how they're going to exchange value. They're going to do this through stable coins and tokenized assets. And most interestingly, once the dollar is tokenized and once the assets are tokenized, we could have financial services being offered by AI agents. So that's why we expect a very significant growth in the AI economy. And the AI economy is it's going to use blockchain solutions because that's the best way, that's the best rails for payments, best way for financial transactions, and best way to, keep identity and data private. So all those benefits of crypto are coming to AI, are going to facilitate adoption of AI. That's why we're also very optimistic about this segment. It's still a very emerging segment of crypto. It's more like venture capital type investment. It's very early, but we believe that as we're seeing like this very significant growth in AI and all this development on AI, and we're seeing more clarity on adoption of tokenized assets and stable coins in the US, it's natural to see more crypto AI applications and AI agents leveraging the crypto infrastructure to offer better services to our society.
Now, your new report also includes updated asset allocation guidance, with Hashdex now recommending a 5 to 10% crypto allocation for most investors. Your report notes that institutional adoption through ETFs, improved regulatory clarity that we spoke about, and macro pressures are reinforcing crypto's position as a core investment pillar. Take us through other reasons why investors should allocate 5 to 10% of their portfolios to crypto.
So Talia, crypto is already $3 trillion market cap, an asset class with $3 trillion in market capitalization. That's 1% of the global investable assets. So if you don't have crypto, you actually underinvested, you're underweight a very significant sector of our economy, a sector that has been growing exponentially in the last few years. That's why now that there are ETFs out there and there is regulatory clarity, we're seeing a record inflows from institutional investors looking to allocate into this space. And the most interesting thing is that all the conversations in the last 2-3 years have been around Bitcoin, because Bitcoin has been going through a great phase of adoption and maturation. But now with this regulatory clarity, with stable coins, tokenization, the emergence of AI, we're seeing more and more conversations around other crypto assets, smart contract platforms, decentralized finance solution. And most important, now finally, there are crypto index ETFs available in the US market. So all those things are contributing to create a more institutional grade solution for institutional investors that are more comfortable in making their allocation. For the last 8 years, we've been talking about a 1 to 5% allocation to the space in a diversified way. And this is mostly because we wanted people to get out of zero. And now we believe it's time to actually have part of your risk portfolio allocated to crypto. That's why we're talking about a 5 to 10% allocation. And we're seeing most of the investors in the US looking for this, starting with a 3 to 5% allocation and improving this over time.
Okay, that's all for Crypto World today. We'll be back again tomorrow, and we'll see you then.